For disclosure purposes, our site does not make recommendations for purchases or sale of stocks, services, or products. Nothing on our site or this podcast should be construed as an offer or solicitation to buy or sell products or securities. All investing involves risk and possible losses. This podcast is for entertainment purposes only. Please read all disclosures and disclaimers at the end of the show. Thanks for joining a Friday edition of the Exploring Mining podcast. Today, my guest is Chris Vermeulen, founder of thetechnicaltraders.com. Chris shares a different way of investing that allows you to own only assets rising in value and profit during bear markets. He believes that investing should be about capital preservation first and growth second. Chris, thanks so much for joining the show today. For listeners that might not have heard of the Technical Traders, do you want to just give a little brief background on how you started that and your success in the market?
Sure. Sounds great, Kelly. Well, thanks for having me. A little bit about myself is I've been involved in the markets for 26 years. I started with fundamental data, buying companies that were very strong, had quarterly earnings. I eventually lost all my money during the tech bubble, even though they were growing. I've realized that fundamental data isn't always the best. It's more so follow price. And so I learned about technical analysis from John Murphy. He's like the godfather of technical analysis. And that's where I've pretty much gone ever since. As an investor, all of us, the only way we make money is if the investment moves in the direction we want. And so I've found ways to track price, follow price as closely as possible. It's not about predicting where it's going to go. It's how closely and how well can you follow it and then manage positions based on how strong a move is going. So I am a technical trader. I manage my own money. I share my analysis and my trades with others. And I've got some really good insights on how to navigate the markets from precious metals, the miners, bonds, currencies, the indexes, you name it. If it has a price chart, more or less it can be traded and invested without taking on a lot of excessive risk.
This year, it feels fairly volatile to start. Like every week seems like a different topic and narrative. Obviously, we've seen some of the tech stocks go down and gold has risen. So it feels a little maybe bearish out there, or investors' mentality is not as hopeful as we'd like to see. What's your commentary of what you've seen so far, just with everything and all the changes?
Yeah, I think we've seen the markets, they kind of been topping out really since December, and they've been trading sideways, a lot of volatility. I think we're starting to see the AI surge. I think it's lost its momentum. It has really flatlined. Semiconductors have flatlined. They're not leading the way anymore. In fact, they've been underperforming. And we're starting to see net outflows. I think we're seeing big institutions and funds unloading the Magnificent Sevens, stocks, which really drive the overall indexes. But the grand scheme of things, this market has been very weak for actually a couple of years. It's been in a topping phase, even though the SP 500 and NASDAQ have been going higher. The Russell 2000 has put in a major double top. Equal weighted stocks are struggling. The majority of stocks in the US stock market and Canadian market are more or less way off their highs and down dramatically. It's just the big techs that have dragged the indexes up, making it look like it's a strong market. So I am more or less fairly bearish on this market. We are still long the equities market at this point from a short-term and long-term investment standpoint because the trends are still up. But when we look at the momentum and where money's been flowing and how gold, as you just mentioned, Cali, is performing, outperforming, that is one of the early warning signs that we're about to walk into some economic weakness, probably going to see some bubbles burst like in equities and real estate. And it's a warning sign. So I believe the top is near if it's not already in. And this year, I think is going to be very difficult across the board. It's going to reset most asset classes, which is an opportunity to the downside. And it's an even bigger opportunity once the market cleanses itself and we have a financial reset for us to move into assets like gold, silver, miners. I believe this will be that next move, kind of like coming out of the 2008 crisis where gold, silver, and miners rally for many years and go up hundreds and thousands of percent. And I talk about this regularly with my followers. This is like the next one we're waiting for, the big exciting move, but there's going to be a bit of short-term pain, I think, between now and then.
Well, I like the outcome and the forecast for mining and gold. The rest of it sounds a little bleak, but that's okay. Are you seeing where this money is transitioning right now? If people are leaving tech, like, do you see this actually correlating into the prices and like buying of gold, or is that money on the sidelines that you feel right now?
I definitely think some money's going into gold. People are worried for a bunch of different reasons. And I think a lot of people are worried about the banking system. So I think they're, if they are liquidating, I think a lot of them are going into physical gold to stay away from the banks in case they go bankrupt type of thing. People are nervous about currencies and banks. We're also seeing record amounts of cash on the sidelines, which tells us people are nervous. Warren Buffett's like 30% in cash, which is huge. I think it's his biggest cash position ever. That is also a warning sign. And I think one of the reasons we're seeing so much cash on the sidelines is simply we have the largest group of people that are close to retirement or retired ever, and they want to preserve their lifestyle, preserve their capital. They're worried about what's coming. And so there's an argument on the other side saying, well, there's so much cash on the sidelines, the stock market should just keep going higher. I don't believe that. I believe that there's a mentality and a sentiment and an age demographic that's going to bend this, which is why we have lots of cash. People are more happy to preserve their lifestyle than try to risk it at their age category. So I think it's going to be very interesting how it unfolds here.
Do you forecast for the price of gold as, we run into this bearish market? Do you think we're for a price down, like back to like the 23 or 2400, or do you think we'll keep around that 2900 and possibly break out the 3000 level?
Yeah, I think gold might want to continue to push a little bit higher. The next target on the chart is about 3050. It's not very much higher from where it is right now, so there's not a lot of upside left there. But I do believe we'll probably see gold pull back to potentially 2400 an ounce or so, somewhere in that range, which isn't off from what it did in 2008. We saw it pull back about 34 plus percent. And that'll be a big reset. That was a big breakout level. That's also going to become now a support level if it pulls back to 2400. And that to me is going to be the ultimate buying opportunity. I know people don't want to hear that, but there's very good odds that when there's panic selling in the market, we're going to see gold get pulled down with it. It doesn't defy gravity. It still gets pulled down when people are nervous. And a good example is you and I are talking today, and it is, February 25th, and there's a big bout of fear and panic in the stock market. Stocks are down and gold's down. Gold's down like 1.5%. And this is what happens when there is huge global fear. Is almost everything goes down, and when people get nervous, they just say, "Get me out, liquidate, move me to cash." They don't care what their assets are, and that's the problem with the bear market. A lot of people are like, "Well, we can go to this sector, we can go over here to this commodity and protect ourselves." The reality is, when big selling starts in a bear market, it pretty much pulls everything down. You have to look at it as an opportunity. And that's what I see it as. I see there's downside opportunity, and even more so once it's cleansed itself, I think we've got huge upside in the precious metal space, and it's going to be something that'll be one of those life-changing investments, like it was coming out of the 2008 financial crisis. Gold, silver, and miners were a life-changing bull market. And you really only get generally two or three of these opportunities in your lifetime between various asset classes, just because these cycles are huge. It usually takes people 1 to 2 of these massive financial resets to actually like understand it and see one coming and take advantage of it. So if you can catch one now, especially if you're 45 plus, it'll be a huge boost. It'll supercharge your retirement account if you catch it right.
With the markets, and you're talking about maybe this pullback and reset, what are your suggestions for investors out there? Because I know a lot of us hold junior mining stocks or whatever those are, and they're not at their highest right now. They're lagging. What do you diversify, or what do you suggest, or what do you see as an opportunity that you can still hold those stocks and still find as other profits in the sectors when tech is not looking so sexy anymore?
Yeah, exactly. Well, that's a good question. I think we're going to see. So there's a few different ways you could play it. One will be when the stock market does turn down and the trend is confirmed that it's falling, and we're in a what I call a stage 4 or a bear market. You can bet against the market. I mean, you can buy inverse ETFs that go up in value as the stock market falls. So if the market falls 20%, you can buy an ETF that will go up 20%. It just does the exact opposite. But you have to wait for the markets to rotate and turn and roll over and have that. Another play that will come into action will be potentially the bond market, like TLT, the long-term Treasury bond ETF. That has got some good upside potential, and I do think it's putting in a major bottom over the last couple of years. I think it's going to have about 10, 15, 20% upside move over the next year or so. I think as the economy unfolds and kind of crumbles to some regard, I think we're going to see that become an opportunity. The other one is the US dollar index. I think owning the index, the US dollar index, is a strong play. I think it has about 10 to 20% upside. And I like the US dollar simply because it is a fairly low volatility move, meaning, in 2022, well, the stock market fell about 25%. The US dollar went up 18%. And the biggest pullback from the highest high to the lowest low that year during that rally was less than 4%. That is very small. And that's what I like about it is currencies have a nice way of trending for many years. It's in a strong uptrend. And usually when the economy and kind of the world and markets fall apart, we tend to see people move to the global reserve currency. We tend to see dollar move higher fairly dramatically. So there's three ways to take advantage of it, or a blend of all three of those. But they're all going to probably trigger at a bit different times and allow you to kind of navigate the downside and the chaos. Relatively low volatility and pull money out.
So you do obviously a lot of charting for all of your followers. So if someone's new to investing and, explain it like I'm five and some key indicators are for them to pay attention to.
Yeah, so long story short, I can share a chart of gold and give everybody a little visual kind of a taste of what I do here. Let me just show you. If we take a look at this, this is the monthly chart of gold going way back to where the last super cycle for gold started back in early 2000. We had the 2011 top, and then we went into a reset. So I use a tool. I actually just did a video on this on how to use Fibonacci extensions. Now, if you don't know what Fibonacci is, everyone should go look it up. It is pretty much in everything in the universe. Very powerful sequence of numbers. And I use this tool to gauge where we are going to see market rallies. So this tool tells us from where the market rallies, where gold is rallied to the major peak. This was a super cycle. To where it pulled back, we can carry that forward to where it should find that next level. So we find the low, and it's going to give us two price levels. The first price level is this orange line here, which is the 61% extension. This is the most powerful sequence, the most common one that's reached, meaning price should rally to this level. And then if it pauses and takes a break, it's going to almost always go up to the 100%, the one level, meaning the size of this move is matched percentage wise with this move. And so gold hit that level just a couple of months ago. It's had a hiccup. And now we're in what I think is a kind of a bit of a blow off phase. We actually saw the same blow off phase right over here. We saw a similar blow off phase right over here. It's hard to see because the chart is expanded to the upside, but once you hit this target, this is where everybody piles into that commodity as like it's headline news. Everyone who feels like they've missed out, who's not in it, they have FOMO, they get in it and they drive the market up. So I believe we're a little bit of a bubble phase in gold, and we just have to let it shake itself out. And then it's going to pull back and consolidate and set up a new launch pad for us to draw another Fibonacci extension, which then points to higher pricing. And so we can do this on multiple time frames. This is one tool. I also use cycle analysis and sentiment flow in terms of is money flowing between stocks or utilities or gold or currencies. Depending where money is flowing tells us what people are thinking and doing. And if we know what the majority of people are doing, we can hop on and ride that trend and be positioned for it. So that's what I do at my website, which is thetechnicaltraders.com, or my YouTube channel, The Technical Traders. And more or less, I provide shorter term chart analysis, daily analysis, morning trades as well, using this on different time frames for the stock indexes and sectors and things like that.
What is your favorite chart that you're looking at right now? Is it the setup for gold? Is it the setup for silver? Is it consumer? What?
There's two very interesting. So one of them, the most boring one I just mentioned before, is this US dollar index. If we were to take a look at this is the US dollar index ETF, and we can gauge where this market should rally based on a few different levels of price action. But we've got a couple targets here. So let me just grab this low here. We've got a few different targets to the upside for this. And I believe we're going to see, 125 on the dollar index If the dollar goes up, which is typically what happens during a chaotic economy, that is not good for gold. This is one of the reasons why gold goes down, is we tend to see everybody liquidate, move to a currency, and that will pull gold down. But so I like the dollar. I do believe we're going to go up and see a big rally. The other interesting play, which is actually an inverse play, I'm hoping it's going to have a big drop, is actually the energy space. And um, we have energy stocks trading near all-time highs. Each time we got up here, even just before the 2008 crisis, it had a huge drop. Whenever we get to these economic kind of weak times, we usually see energy stocks doing very well, and then they collapse. And so we have this big divergence, meaning oil or energy stocks have been moving higher. They're up near all-time highs. And when we look at the chart of crude oil, it's going in the opposite direction. Oil has been going down for the last few years, while energy stocks have been going up. And this, Cali, plays into a really interesting chart. If we were to take a look at the cycles in the stock market, we can see here that typically gold does very well, which it has. It's been leading the way. It's an early warning sign that the stock market and the economy is coming to an end, and energy stocks tend to do very well. And that's just before the stock market puts in this major topping phase. And so that's where we are in the energy space. I do believe we're going to see a very big divergence here. We're going to see a very big reset in the energy sector stocks, because right now they're priced for war, they're priced for high oil, and they pay a lot of dividends. A lot of people have been moving into dividend space. And I think this is going to have a big effect on retirees, because a lot of these stocks pay dividends. Retirees generally hold dividend paying stocks. And this is going to have a very large haircut. I could see the energy space, easily pulling back 30 to potentially 50% over the next year or so. And that is going to create a lot of pain and opportunity, depending on what side of that trade you're on.
I remember when COVID happened and the wild ride that energy prices and oil had then. Do you think that we're in for something of a shock like that again, potentially? I mean, that was the craziest thing I've probably ever seen. So,
Yeah, I mean, we saw the energy sector space here fall, 60% in really 3 months. We saw oil go negative, which I didn't even know was possible, and I didn't even understand it. I wanted to take part of it. I called so many people, but it was happening so fast, and everybody's like busy, and they're like, I can't talk right now. Everybody was trying to figure it out. I do think we'll see a big unwinding in the energy space. Do I think energy will go negative? I don't know. I kind of feel like that was a one-off event. I think people thought it was like going to be like a zombie apocalypse with COVID. I mean, it was so scary, and it was something we'd never experienced before. I think now we have a little bit of experience if there's some type of disease that's spreading. So I don't think we're going to see, that volatility again of something going negative. But I am expecting, when oil breaks below about 65 or $66 a barrel and holds below there for a month, I think we could see a very big drop in oil down to, 55, $45. Energy stocks are going to get hit because there goes all their profits. They'll be losing money at that price. So I am expecting big volatility, but not negative, crazy pricing like COVID.
how important is or like how how much more work is it in due diligence with charting and the technicals now? I feel like the volatility since COVID again has changed dramatically, and some of the patterns that used to happen, we do see some echoes, but some things you're just not prepared for. Like again, the oil prices. How important is it to understand charting in this world?
Yeah, that's a good question. I mean, we used to do fundamental analysis, and it was a real pain in the butt, looking at PE ratios and earnings and listening to earning reports and all that stuff. And the news, it is a real time suck. The nice thing about technical analysis, I follow it every day. So to me, it's very straightforward. I have my list of charts I run through. I can go through all the charts, just quick glance, clicking on each one. Not much changes day to day. And I'm pretty much set in about 5 minutes. I've gone through everything. I get a feel for the way my charts are set up, where money's flowing on a particular day. Is it into risk on, risk off? Is it into the stock market or into a different asset class? That's what I love about technical analysis. A picture says 1,000 words or more, and especially when you have analysis on it and tools. So one quick flash of a chart, and I'm like, I know all I need to know. Next one, and that's what's really nice about technical analysis. It's a lot less work. It takes a lot of the emotions out of the market because now you're not listening and expecting earnings and you're not getting caught up in other people and their emotions. It really is cut and dry, logical. And that's the way my brain works. I'm a pilot. I'm all about checklists, create rules, find patterns, and then find ways to manage and trade those patterns so that you can squeeze out money and try and reduce risk. And that's what I like about it. It's very quick. You can be caught up in 5 minutes for all the markets and move on with your day. So that's you can't do that with fundamental. If you're news driven and economic data driven and all that stuff, you're constantly listening to news and stuck in an emotional roller coaster.
I feel like the news now is so dramatic that I wouldn't buy anything based on the news anymore. For going back to mining, again, like as we've talked about, that gold prices, have risen. We've had a good run and there might be a bit of a pullback. Do you see or do you have any ideas or what you're thinking for the mining and junior mining, like when that will start kicking in? Because it feels like we've all been waiting, seeing gold go
Yeah.
up, and then it just is not translating into the miners.
Yeah, we'll be lucky if the bottom gets put in this year. I have a feeling it's miners will probably be putting in a bottom in early 2026. And then from there, the sky's the limit after that. Then we go up to see like if you're to look at like GDX or GDXJ, and they probably go back up and hit those highs that we saw back in 2011, 2012. We'll have a big run. But I think they're still carving out a bottom. The charts look very bullish from a long-term standpoint. When you look at gold miners as a basket, the charts are very strong, pointing to more or less 100% return on the index. It's on the ETF like GDX. So there's a lot of upside, but I do think it's going to take time. We need another 12 monthly bars. We're going to probably see some selling. At that point, we'll see these sell off a bit and there'll be a lot more upside potential percentage wise because the price of the shares will be down. So they are coming around. They have carved a bottom, but it hasn't really fully started the next uptrend yet. It's very close, but 2026, January 2026, maybe. I still think we need another year or so. The nice thing about miners is they do bottom before the stock market does. We saw this in after the last the '08 kind of crisis. Miners bottomed in gold months before the stock market does. So maybe late this year we could see them actually find a bottom first, and people then want to move into gold and silver and miners because they don't trust the financial system because banks will be blowing up and companies will be going bankrupt. So late this year, early next year is the window, I think, where the bottom gets put in place, and then we should be laughing for quite a few years after that.
Okay, I like it. I've waited long enough, but one more year I can handle. Is there any other stock market myths or, stories that you would like to debunk for investors that are out there that, maybe again are new to the commodity cycle or new to the last few years of how everything's changed?
From a really high level, I don't believe in the buy and hold because when we go through a bear market, a recession, almost everything goes down, as you and I just kind of talked about. So if it's going down, why the heck would we want to hold it, right? So I came up with an investment strategy, which I call asset revesting. And that is taking our money and we reinvest our money into a different asset class. So when stocks go out of favor, we pull our money out of equities and we go to somewhere else. Could be bonds, it could be a currency, could be precious metals, could be whatever that next wave is. So I'm all about holding only assets going up. And I'm not a big fan of massive diversification. I don't want to hold stocks and bonds and everything together because you dramatically underperform. When you diversify, you're going to have winners and you're going to have losers, and your losers kill the profit of your winners. So the whole strategy that I focus on is let's hold only assets going up and dump anything where the charts are sideways or going down and just keep our money working for us. And if nothing meets our criteria in a short-term window, then we actually hold it just a cash position and earn daily interest, which is a lot better than watching your money go down with the market as it falls. So that's kind of the whole thing that I focus on is just find an asset going up, hold on to it. And some of these trades, like there's generally like 5 to 12 waves that roll through the market every year. I like to always look at it like the ocean. A rising tide is a bull market. All boats go up with a rising tide, which is all the stocks. And a bear market, all the stocks and most assets go down. You don't want to be holding them. And then I take it one step further. We'll act like a surfer floating out past the break on the ocean. You're waiting there, and what are you waiting for? You're waiting for a set of waves to roll in. And every year, there's those 5 to 12 waves that roll through various assets and sectors, and we wait for one. And the nice thing about seeing a big, strong wave is we can also gauge when it's starting to weaken. So we can move in, ride the wave, and we can tell when it's starting to get weaker and top. So we can start to trim profits, move our protective stops up, and eventually rotate out of it and then wait for another wave. So I wouldn't say I'm a buy and hold investor. I'm like a position investor. We get into a position, it can last a couple of weeks. Sometimes it can last 6 months. You never know how far a trend is going to run. And that's what's so unique about the markets. If people try to like nail down specific trades, and you really don't know how long something's going to last. So you need a strategy that works with the market. And if it keeps going, you need a way to make sure you stay in it and ride those trends.
So for any investors that are interested in signing up or following you, or how can they get in touch with you? And like, is there a price scalable range for them to jump in, or is it just one program, or how does that work?
Yeah, so the best way to get in is to go to my website, which is thetechnicaltraders.com. It's a subscription based. So what I do is I just manage my own portfolio, but every morning I share a morning video before the opening bell. I tell you what's going on in the markets, what happened yesterday, overnight trading, and I share the trades I do. So I tell subscribers exactly buy this ETF at the open with this allocation of your portfolio. So whatever amount of money you want to allocate to the strategy that I do, you just really copy it. I provide the symbols, the date, the entry, the targets, the stops. When we update or change those, you're notified. So really, I do the exact same trades members do. We all enter and exit at the same time, and it's a pretty straightforward newsletter. Again, 5 to 12 trades a year, and we just manage our portfolio like I believe it should be. Like most people don't actually manage portfolios. The buy and hold is definitely not a managed portfolio. That is just set it and forget it, and it's designed for poor returns, and it doesn't do much. So that's how I go about it.
So we've made it, I think, over 20 minutes now. We haven't brought up Trump, so I feel like I have to bring it up because he seems like the wild card for everyone. Do you think with him and the tariffs, there's so many different moving pieces that he's thrown at us in the first couple months already in. Do you think that's going to have a massive impact again for like the short term, long term, or do you think that'll kind of settle out as people get used to the wild card being back?
Yeah, I think he's definitely a wild card, and we should expect wild volatility, I think, for probably 4 years. I think people will get a little more used to it. Like I already feel like people are starting to get used to it. Like, oh, it's another thing, right? Like we keep seeing these big pops and drops in the market based on what he says or does or implements and then unimplements. But I think, yeah, where it's going to be volatile, the tariffs are good, definitely throwing a wild card in currency swings, the markets, and it adds another layer of complexity or more or less risk just because we have these big swings that can kick you out of a trade potentially and then be reverse the very next day or the next week. So it makes things a little more difficult, but there's not much we can do about it other than adjust and work with it.
I always ask at the end of a podcast, like, what is your favorite story in the market? It could be from years ago or last month, but like your biggest win or like best lesson learned from the market.
The best lesson was blowing up my last futures trading account. So I've blown up 3 trading accounts. I remember I was trading futures, day trading futures, and I was buying into something and it just kept falling through the day. I was like, oh, this was before I knew what I was doing. And I kept doubling down, adding more contracts, averaging down, and just like the market has to bounce before the close. And it didn't. And I got a margin call and I blew up my account. And that was my second account. And so then I was pretty shaken. A couple of weeks later, I got some money back funded into an account again. And my very first day I opened it, I got in and it was like revenge trading. I'm like, I have to make back what I lost in the last one. I did the exact same thing again, and I blew up my account the same day I opened it. And I never really told my wife about it. And it just devastated me. Mentally, I was broken. I couldn't believe it. And I stopped trading for several months. I didn't know what I wanted to do. I was like, I just can't do this. The market had me. And that was my wake up call. I also went through a bankruptcy when I was younger with my parents. And so I have gone from the top to the bottom. And that was kind of the one that realized, like, listen, if I want to become successful, you have to have risk management in place. You have to be disciplined. You need a strategy and you have to follow it. And emotions are the worst. The second you feel emotions creeping into something, you really do have to like walk away, take a big breath, walk away. It doesn't matter if it's a relationship thing or a stock market thing or business deal. Like you really can't let emotions get in because it's so easy for things to get out of hand very quickly. So, yeah, biggest loss was blowing up an account, and that mentally shook me and put me to like maybe have to straighten up and create rules and strategies.
And what was your biggest win? Because I feel like we have to know now after that.
My biggest win was it was a penny stock that I bought. I kind of helped get going, and I had a bunch of warrants in it. Some other newsletter pumped it up, mentioned it in their newsletter one day, and I woke up and I had it at like, I don't know, 4 or 5 cents or something like that. And the next day it opened at like $1.45.
Wow.
And I was just blown away. And I think I was maybe 22 at that age. I didn't even know how to deal with a warrant. I had this like piece of paper. I was going around to the banks in my town. I'm like, how do I cash this? How do I sell it? Can I short it? Can I hedge it? Like, and it was like a really quick couple hundred K like made, and I was shocked. And that got me into the small cap space. But usually small caps or micro caps are, they're very volatile. You usually give back what you make unless you can time these major cycles, which this next cycle will start late this year, early 2026. And that will be the junior micro cap, I think, time to get back in and, make huge, huge returns. But until then, as you mentioned, it has been like a struggle waiting for the miners to bottom and start their big run. And we're
Well, that
getting
does it
really,
for today's
really close,
Exploring
but,
Mining
a
podcast.
little bit longer,
If you'd
I
like
think,
to be a
than
guest or
it's-
sponsor for this podcast, please contact InvestorIdeas.com. InvestorIdeas.com reminds all listeners to read our disclaimers and disclosures on the InvestorIdeas.com website. All investment involves risk, and this podcast is not meant to be an endorsement to buy or sell securities or products. To hear more podcasts, you can go to InvestorIdeas.com/audio. And a reminder, you can also hear our podcasts on iTunes, Spotify, Google Play Music, iHeart.com, TuneIn, Stitcher, Spreaker, and SoundCloud.